following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that rocking theme song means it is time once again for everyone's favorite options education program. Of course, I'm talking about Options Bootcamp, the program where we take you, the basic retail options trader, and proceed to break you down through some horrible, grueling, devilish experiments on our part, and then proceed to rebuild you into seasoned professional options trading veterans. My name is Mark Longo from the OptionsInsider.com, as well as from the old Options Insider Radio Network. And I'm pleased to be joined here on this final episode of 2013 by my usual cohorts, my usual companions, my usual partners in crime. Starting off with you, Mr. Passarelli, beaming in from lovely, scenic Frankfort, Illinois. Right here, they have 7 feet of snow right now. He is, of course, the major domo over there at Market Taker Mentoring and the MTM Elite Community. None other than Mr. Dan Passarelli himself. Mr. P, welcome back to the program, sir.
It's great to be back, and it's only 6.5 feet of snow, by the way.
Don't let me ever shortchange Frankfurt again, sir. All right, and of course, joining us from the far, far east, a.k.a. New York City, right here it is 75 degrees and sunny right now. He is the other major domo coming to us from the land of SogoTrade.com. He is none other than Mr. John Critchley. John, welcome back to the program, sir.
Hi, folks. Yes, it's quite balmy in New York City, as always, of course. It's that time of the year again, and I'm looking forward very much to this holiday show. Should be fun.
And I think without further ado, let's get to it and dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to our final basic training segment for 2013. And as we were putting together the rundown for this final episode here of the year, we thought, what's a good topic to really close out the year on? And we thought, what better, what's more appropriate than perhaps give you, the listeners, our own options-related wish lists for the coming year, for 2014, for what we wish we would like to see in the options market, what we'd like to see you guys, the listeners, do, what we'd like to see happen in the world of options, and things that we think, improvements and changes that we think could really improve your options trading experience. And I know, John, you've really been putting a lot of thought into this, and you really have. I know you're just dying to get to this because you have a lot of great suggestions. So I will open the floor to you, sir. for you to regale our listeners with your first wish for the coming year of options.
Yeah, my number one wish list on the wish list is I wish there were some consolidation in the exchange marketplace and there were less exchanges. You know, the one issue I have, and this is a big issue we have every day, is there is no general opening print available for options. In other words, if I enter a customer enters a market order pre-market, it goes to one of the 12 different exchanges, and the market makers there can print at any price. And the more fragmented we get, the more marketplaces we get, the more chance we have for customers getting bad fills, the more chance we have for, even during the day, wider markets. I mean, I prefer the old days where there were 4 or 5 exchanges. Of course, the CBOE, the Amex, the Philly, and the Pecos. Each one had its own little niche. And then the ICE came in, which is fine. They changed everything. Competition is good, but at what point is there oversaturation and the marketplace becomes so fragmented that the system just breaks down? So I hope that we stay where we are, maybe, and maybe they consolidate even more, and we just stop adding more exchanges.
I'm going to actually jump on that bandwagon as well, because I definitely echo that. It's funny. From a selfish standpoint, I should want there to be 1,000 exchanges, because that means there's more competitors out there in the space bidding for the limited inventory that is available on the optionsinsider.com and on the Options Insider Radio Network. It's actually a good thing for our business to have more potential sponsors out there. And yet I've seen just how, just even increasing to a dozen, we've gone up about 70% in exchanges over the past 5 years. Just the horrible negative ramifications that's really had for the options market, particularly for the audience of a show like this, the retail options audience. When we created the Options Insider back in 2007, and for many years after that, the number one question we received on a regular basis was, if I buy a call, out of the money call, and the underlying rallies, and my call didn't go up, or it lost money, or didn't go up as much as I thought, why is that? That was probably the number one question we always received. That's kind of been replaced in the past 6 months to a year or so by questions about spread execution. Why I was trying to work this 10 lot, the MBBO was here, I was here, why didn't I get filled, or how do I get filled, or different variations on that theme. And that's a terrible thing, because people have come into this business through brokers like yours, John, over at Sogo Trade and all the others, and you guys have really done a great job giving them a great execution experience on the NBBO. So they've come in and they're used to seeing a call market that maybe is $1 at $1.05. They know if they lift that $1.05 offer, hit that $1 bid, guess what? They're going to get their 10 lot off or their 20 lot off or whatever, however much they're trading. And so they've come up expecting that level of functionality, and that's a good thing, that level of liquidity. And yet when they get to spreads and they try to do the exact same thing, and they try to buy a 10 lot on the spread NBBO or sell it, all of a sudden their trade is locked in a spread book on one exchange, and one leg is offered here, one leg is bid here, and it's a complete mess. And explaining that to the clients and the customers why they didn't get filled, at the end of the day, they don't care. They don't care what's causing all these issues. They just want to get filled, and I don't blame them. And so and a lot of this can be traced back to just the explosion of exchanges, the different models, the different spread books that don't talk to each other, which is a huge problem. Every exchange has their own spread books, kind of locked to their own exchange. They don't want to send orders away, of course, because they're for-profit public entities with investors and analysts following them. So every order they send away that isn't filled on their exchange is lost revenue, in their eyes at least, even forgetting about losing customers. They apparently don't care about that. So it's just become a mess, let alone in the last 6 months, the headline-making technology disasters we've seen, a lot of them localized to the options and derivatives markets because there's been such an explosion of exchanges. So the connecting to all these exchanges, the cost associated with it, the messaging and bandwidth that has come about as a result of that. Messaging is up 250% over the last 5 years. I mean, it's the costs of doing business for the trading firms, for everyone. It's just exploding because there's so many more data centers and also more underlyings and options series and as well. That's also adding to the problem. But a lot of the core problem can be traced back to there's just too many exchanges. A lot of them just operating sub 5%, often sub 3% in terms of total market share. So they're not bringing any real liquidity or any other added value to the pie. They're just kind of taking up space and complicating things and adding, as we've seen in the last 6 months, adding a demonstrable risk to the marketplace. I don't know what will fix it. I've talked with a lot of the heads of the exchanges here in the options market to kind of ask this exact question. What will it take to bring about a change? Is it regulatory? Is it something else? And No one really seems to have a good answer to that question. It seems like these exchanges are just staying afloat enough to make it worth their time to do this, regardless of the other ancillary unintended consequences they may have on the marketplace. So yes, John, if I may be so bold as to piggyback on you there, I will definitely agree that I would like to see some consolidation in the option space overall in 2014, even though I don't really think, given everything we're seeing in the tea leaves, it might actually go the other way. We might actually see some more exchanges before we see fewer. Mr. Passarelli, what is your number one holiday wish list for 2014?
I'm going to give you my wish list, but can I just piggyback also on that, John?
No, one
Mark?
piggyback only per show.
No, I would kind of like to piggyback on that just a little bit also. I mean, like the whole idea of an exchange, right? Like the initial concepts 200 years ago or whatever of an exchange was to have one central location so that there's transparency and so that there's fungibility and that there's like all the players in one area. And that's like somehow that's gotten lost sight of. And many of the problems that we're seeing right now in the market, of course, as Mark just pointed out, is because of all the different exchanges. When there's a power outage, it's because there's so many exchanges that it's so confusing just electronically in terms of communication that it causes exchanges to go out. And do you know why we have so many exchanges? Because the SEC approves it. They're the ones who wanted this. They're the ones who wanted all these exchanges. They're the ones who are allowing it, who asked for it, and now they're getting it, and it's causing all these problems. So, yeah, I just wanted to jump on that bandwagon too. But now I will give you my wish list. I wish to see continued growth in the options business. It's an industry that I've been in for well over 20 years now, and I'm not in this industry by default. I'm in this industry out of passion because I believe in it, because I believe in what options can do for a regular Joe, for some guy who doesn't have a lot of money, but he owns 100 shares of some stock and he wants to protect himself, or doesn't have a lot of money, has been holding on to this one stock and he can't sell it because he's owned it for 30 years and he doesn't think it's really going to go up anymore, but he wants to generate some income on it so he can trade a covered call. I believe in the options industry over the last, I was just looking at a graph of this, over the last like 20 years or so, option volume has increased almost every year. It dipped a little bit in 2012, I think, but it was still 4 billion contracts in 2012. The numbers obviously aren't in for 2013 yet, but that's what I want to see, continued growth. I mean, you would think as a trader or investor, I'd say, I want to see the market up by however much. It doesn't matter if the market's up if you trade options. You can make money if the market goes down. Or even if you're a conservative investor who holds on to shares of stock, if the market goes down, you can protect yourself using options. So that's what I want to see. I want to see more people using options, and I want to see them using them more to their benefit.
A great suggestion there, Mr. P. And I think I'll go next and give John a time to carve up his list into his next point he wants to hit on. I think you hit on a good topic, and I think just over this past year, what we've seen in the realm of options, even getting away from the volume and exchanges for a second, just the general perception. Every year it seems like we're past that hurdle. Maybe perhaps in the terms of the general perception of the general media, whatever, financial media, whatever you want to call them, the general public, the investing public, thinking that options are this destructive, dangerous, risky thing. And yet, this past year, we saw options and derivatives being used improperly yet again. We saw, of course, the JP Morgan whale, quote-unquote, hedge. Of course, we've just coming off of in recent years things like AIG and others, or people are using derivatives, and of course a lot of those were swaps and OTC products, but still they were being used improperly, and of course adding a lot of risk when they're used properly. Of course, like we've discussed on this show many times over the past couple of years, when you use options properly, they are indeed risk mitigating, not risk additive. We even saw that big quote-unquote expose in the New York Times a few months back that I know, Dan, both you and I attempted to address with the author. They're trying to paint options as some sort of tools that just steal money from grandmothers and destroy the accounts of retail and are really, really treacherous, when anyone listening to this show hopefully knows, and of course all of us here on the panel know, that when used properly, when used in the way they really were designed for, in a risk mitigating fashion, that options are something that everyone really should have in their portfolio. If you're just a long stock guy, guess what? You have tons of risk. And your only option is to sell it or not sell it. And that's it. And if you're a lot of people sitting in the market saying, wow, this market's gone up quite a bit. I don't know if I should sell, but I may miss some upside if I sell it. And they're doing the same dance over and over again. Guess what? You don't have to do that dance. Just buy a freaking put or do any of the other strategies we've outlined on this show so many times. And you could keep that exposure and not have to worry about all the downside stuff. So it's just simple things like that. And those messages still haven't permeated out to the masses. I'm so glad a show like this has been so popular, because it really helps to spread that word out to the exact audience we're trying to address, the basic retail options customers, and tell you, hey, options aren't scary. Options aren't risk additive. They're risk mitigating. And so if I want anything for next year, it really is, hopefully, we won't see any more of these quote-unquote hedges. The vocal rule, I think, is going to have something to say about that as well, where people are using derivatives in a completely improper fashion and, of course, ruining the game for the rest of us. And, of course, hopefully we'll see fewer, if perhaps none, of these exposés and these large mainstream financial or just general media outlets trying to paint options as some sort of demonizing instrument, when the truth is they are appropriate for the vast majority of investors out there, and they really are tools that you, and if not you, certainly your financial advisor or asset manager, should be employing to your great benefit. All right, with my number 2 wish in the books, I will turn it over to Mr. Critchley, who I know is just champing at the bit with many, many wishes for 2014.
I have 2 really quick ones. I wish every customer would close every expiring position. We've gone over this many, many times. But let me mention one thing about that. And every broker, online broker, there is a exercise and assignment fee, which ours is $15, which is below market rate, but there's a fee for that. So even if you throw away all the marketplace risk and other things we've mentioned in the past, it may make economic sense if a position is in the money to close that position. It may cost you less than having the $15 fee imposed on you. So that's number 1. And very quickly, again, I wish customers, unless it was absolutely dire and they need to get a fill, would never use a market order on options. Now, again, if you're trading Spider or you're trading the Qs, you market order, most likely you're going to get filled on the bid or the offer. That's fine. But if you're trading an illiquid option, you may get a price away from the marketplace. Again, if you have a option that is trading, let's say, one bid at 110, try to throw a 105 bid in there if you want to buy. Most likely than not, you will get filled. So just be careful and try to use limit orders if you can. And if you need to really buy it, put the limit order buy above the ask price. Or if you really need to sell, put it below the bid. At least that way, you know what price you're going to get in the worst case. So those are my number 2 and number 3 wishes for the year.
Mr. Passarelli, what's next on your holiday wish list? What should we put in your stocking for 2014, sir?
Well, this may sound like I'm a little biased here, but
everyone go out and buy my books.
Yeah, right. Well, you're kind of on the right track. I would love to see a more concerted effort of options education, and this kind of goes along with my first wish a little bit. And I am a guy who provides options education, of course, but it's kind of the chicken and the egg. I don't want people to learn options because I provide education. I provide education because I want people to learn options, because I'm passionate about it, because I think it's the greatest investment vehicle that's available to the common investor. And I just want to see just a more ubiquitous use of them. And I think the only way to do that is really get the word out there, and more shows like this one, and more educated people who are writing articles, kind of like you touched on just a minute ago, Mark, and just a better understanding to the general public about what you can do with options.
And the best way to do that, listeners, visit Market Taker Mentoring, sign up for the MTM Elite Community, and of course, pick up a host of books by one Dan Passarelli. Great ways to educate yourself on their options. No, but seriously, actually, I think I'll jump in and just do two quick ones like John did, touching on both of the points you guys both raised. I think the closing out shorts is a great one, John. I would echo that. And I would also say I love what you guys are doing at Sogo to address that with the commissions and reducing them. I wish I wish that would be standard throughout the industry. I really wish every brokerage firm would take that effort. And it's as you've shown, it's not a de minimis, it's not an insubstantial effort to do that, but the rewards are demonstrable. If you're going to incentivize people, if you're going to get people to do the right thing, you have to incentivize them. And in order to get them to close out those shorts below a dime, particularly below a nickel, ones that they've already decayed to the point where they're getting the maximum bang for their buck, then you're going to have to give them cheap, if not free, commissions. And so I wish every brokerage firm that did options and handle options on the planet would embrace that, because it's good for them, it's good for the retail customers, it's good for everybody. Good point about the assignment fee and exercise fee as well. A lot of people don't realize there's that $15 fee floating around there. They may end up saving themselves some money closing out these positions as opposed to getting exercised or assigned and paying that $15 fee. So a good little point there. And on your tip about education, Dan, I think I would jump in a little bit there too and just say I see so many people doing education and they're still doing it, the same old way of here's an option, here's a call, here's the expiration diagram, here's where you break even, here's your maximum gain, maximum loss, here's how this naked short put looks at expiration. And as we covered on the show many times, first off, most people don't hold their positions to expiration, so that's a very extreme example. And for really basic instruction, maybe showing people the extremities of their risk, there's some value in the expiration graph. But too much of options education has just been rooted in that for too long. When where the rubber really meets the road for so many options trades and traders is what happens in between. How do you adjust? What do you do when the thing moves against you a little bit? What do you do when it moves your favor a little bit? When do you take this off? When do you roll? Do you take off half? Do you take off all of it? How do you adjust these things? The adjustments are so crucial, and there's such little focus on that in the world of options education. So if I have two more wishes for 2014, I would say both of those, that every broker out there should get on the free or reduced commission bandwagon for closing out shorts below a nickel, and all educators should just try to move away from the expiration graph, because it's gotten us to, I think, a dark place in the realm of education. And retail traders and option traders in general, they need better and more information to really understand what goes on between when you open the trade and when you close it. All right, Mr. Critchley, what's next on your extensive wish list for holiday and beyond into 2014?
I wish that customers never or almost never traded the inverse or leveraged ETFs. And if you do need to trade them, just keep in mind that they are very, very short-term trading vehicles or instruments. Mark, I'm sure gets questions about this all the time, and they have so many shows on the radio network about volatility and the VXX and the underperformance and all these things. And just be very careful when you trade these things. Trade them for a day or two. The longer you trade them, a lot of these products are path dependent. What that means is that they will outperform if the market goes straight higher. Boom, 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 boom. But if there's any little volatility going up, going down, going up, going down, which that's what the marketplace normally is, it's normally not a straight line either way. They're going to grossly underperform. So just be very careful about using that. And also, on the same vein, if you're trading a leverage or inverse ETF and you trade options on that, and I think Dan hit this in the last show or 2 shows ago, you're trading a derivative of a derivative product. Think about that for a second. So be careful with those also, because they don't always act the way they should also. And that includes the VIX too, a derivative of derivative. That is tricky for most retail customers.
You sound like me, John. I was having this discussion with my own father just a few nights ago, how he's a big fan of one of these leveraged inverse S&P ETFs, and I was walking him through all the different things you just described on reasons why he may want to stay clear of that, and yet for whatever reason, he still clings to that one. So even in our own family, sometimes we can't walk them away from the dark side. Mr. Passarelli, what's next up on your wish list for 2014?
I hope to be successful in guiding my students and potential students' expectations of options. One of the things that I see all the time is somebody will call me up and they'll say, yeah, you're the guy who teaches options, right? Yeah, I am. Well, yeah, listen, I've got a $5,000 account. I'm hoping to make $10,000 a month for the rest of my life. Do you think I can do that? And yeah, I'm kind of joking here, but I'm not really joking at all. Like, I get phone calls just like that once a week. People get these emails, from these spammers, these guys who've never actually been traders, who promise these ridiculous things. Like, I make 1,000% on every one of my trades. I've never had a losing trade. Sign up for my newsletter that I sell for $5 a month. Because all I need is $5 to make you a millionaire. It's just ridiculous. And so, I can't wish that people have more reasonable expectations. All I can do is wish that when they do call me, that I can make them see the light and see that options can be really great, and you can be really successful, and you can make a lot of money trading options, but, rein it in a little and be a little reasonable. So that's what I want to do. I want to help guide my students and potential students and show them what options can do, and explain to them that they can't do some of these things they think they can do.
So just to paraphrase, then, all of your students are crazy. That's what you're telling us.
No, I've got some great students. The ones who actually, those guys who want to be millionaires tomorrow, they don't end up signing up with me because I tell them the truth, and they don't like that. You actually have to learn things and put that knowledge to use, and and you actually have to work a little bit, and then you can maybe make a lot of money. But they don't want to hear that they have to work or try or learn. They just, so the get rich quick guys tend to not sign up with me.
They go spend their full $5,000 on the straddle course, and
yes, exactly.
They have fantastic results.
Right.
All right, yeah, and I think I would jump in between both of those as well, and just and John, you brought up the ETF and the leveraged ETFs. I would even go a little bit farther and just moving people beyond the levered ETFs. Just in the last few years in particular, we've seen just the fixation on VIX and all of the attendant products around VIX now. It's created this entire universe and ecosystem of not just VIX and the VIX options and the VIX futures, but all of the ETPs that float around it, 2X, 3X, garbage like TVIX, VXX, all these things have really just taken off. On the one hand, they've been demonstrably good for the options audience as a whole because they've brought in a new category of customers, and they've intrigued retail about concepts like volatility, which are good things, and I think those are good things. But in many other ways, they've also, I guess you can say, really overpromised and underdelivered. People have been sold a lot of bill of goods around VIX that it's this perfect hedging tool, and people have used it to disappointing results, if not worse. People have come in and not really understood the nuances of the product. They don't understand how all of these other levered products around VIX work. They don't understand things like futures and term structures and roll risk and all the things that go into a product like this. It's a very, very difficult product to really, really wrap your head around. And on the flip side, there are many alternative approaches that can get you exposure to, let's say, the implied volatility of the S&P 500 if you really want that. There's all SPX, there's SPY, there's all sorts of other options that give you a much more direct exposure to that if you really want, and you can set them up in probably ways that you can understand and they probably fit a lot better with your portfolio. So on the one hand, the influx of interest in things like VIX has been great. We love whenever we write an article about VIX on the site or do a show about it. It gets a ton of audience, a ton of downloads, a ton of traffic. That's a good thing. So selfishly, I suppose I should want that to continue. But on the flip side, I think I wouldn't mind seeing that abate a little bit in 2014, seeing people start to maybe move farther afield into other areas and maybe have the media move away from beating the fair gauge drum. It's sexy, it's fun, it's interesting, but the VIX is not really what it has been made out to be in the eyes of many retail and even institutional investors, and that usually is a bit of a sudden and stark realization for a lot of them when they start looking at this product and how it works and things like settlement. It's just a very messy product when you actually start getting into it, and so maybe I would like to see more people still continue to keep coming into the options market, of course, but perhaps moving on to some products that are better suited for them and for their portfolios rather than obsessing on VIX, sometimes with disastrous consequences. All right, Mr. Critchley, what are the next couple on your list? Because I know your list is quite extensive and quite interesting.
One of my main wishes, and one of the things that really hurts us and the other online brokers, when I first came to work and I left the floor and I came into the retail world, I heard about these day trading rules that they had for retail customers. And I said, well, what are these? What are these rules that you can't? What do you mean I can't day trade? Well, the rules are that you can only do 3 day trades over a rolling 5-day period unless you have $25,000 or more in your account, and then there's other rules, and you must maintain that $25,000, then you can day trade. I mean, it is the most antiquated rule that was implemented, I think, after the tech burst to protect the retail customer, I guess. It's extremely outdated. We have customers that every single day get the day trading calls. We educate them. We send them emails. They still get in the calls. And I think it's a rule that they should just do away with. But again, I think it was a knee-jerk reaction. And I hope that someday they lift the rules and either lower to $25,000. So basically what they're saying is that if you're a wealthy guy relatively, or you have a lot of money in your account, day trade all you want. They go up and down and day trade all you want. But if you have $5,000, $10,000, you can only do 3 over a 5-day period. And so I think it's a very bad rule and very, very misguided.
Give us another one on your list, because I know you have quite a few burning a hole on your list right there.
Sure. I think that, we had gone over this in the past about an exit strategy. And I think that Dan can touch on this too, that, when you enter a trade or you put a trade on, have a mental stop or have some exit strategy for that trade. I wish more customers, they put a trade on and they forget about it. I mean, we see every expiration that I see a customer long position, $2 or $3 in the money, and they haven't traded like in 2 weeks or 3 weeks, and apparently they're not even watching. So in other words, put a trade on, have an exit strategy, put either a real stop in there, loss, or a winning target price, or put it mentally in your head and have a game plan. I mean, you just don't want to just go in and be selling options, buying options without game plan. So I wish that more customers were, had a trading strategy, firmly in place before they put a trade on.
Mr. Passarelli, what's next up on your stocking stuffer list for 2014?
Well, it's kind of a complicated one. I guess to kind of solve all of the world's problems, what I would really like to see is no crazy blow-ups like PFG and, that kind of stuff in 2014. How about that? I think if we start there, we're taking a pretty great step forward. A, people don't get hurt from the initial fallout, and B, people in Washington who don't really understand options won't make rules that adversely affect the options market as a knee-jerk result of some jerk stealing money from his customers.
Yeah, that dovetails nicely into what I was going to say next for my next wish for next year. There's a lot of crazy stuff lurking on the books there in Washington for 2014. A lot of them could have very, very disastrous consequences for the options market. Things like if you write a covered call against your stock position, treating that position as if, from a tax purposes, as if you sold the stock at that strike, and crazy things that make no sense. Transaction tax, obviously, being another big one that's lurking out there that would be demonstrably damaging to a lot of you guys listening to this show right now. So if I have one big picture wish, I think, for 2014 is that none of this crazy nonsense that, you're right, Dan, was born out of the knee-jerk reaction to these horrible things like MF Financial and then PFG and all these other firms that stole customer money. That's the worst thing you possibly could do. They violated their customer trust and stole their money. I mean, and that kind of thing is so awful that, we're seeing these knee-jerk reactions rise up as a result. It's not unsurprising, but they may have good intentions, but the end results of these products and these proposals will be disastrous for everyone listening to this show. So hopefully in 2014, none of those crazy proposals that are, I think most of them are languishing in committee right now, hopefully they stay there and then perhaps fall off the radar completely. All right, Mr. John, take us home. Give us a few more from your wish list, your final two, the ones you really want to leave our listeners with for your wishes for 2014.
I'm a big advocate of margin, and so I wish more customers. I'm not trying to lead the customer down a risky road, but margin has been perceived, or there's a perception that, again, risky way to trade and everything else. What it really does is it just gives you. It gives you increased buying power and gives you, some intraday leverage. And that includes, I'm talking about equity customers also, but for option customers, we can only give you level 2, which is just doing covered calls and buying puts and buying calls. If you have only a cash account. So if you don't have a margin account, you can't do these wonderful spreads that we talk about. Forget selling and naked options, but even these, vertical spreads. And you remember what Dan was saying earlier, Mark. When volatility gets very high in the marketplace, you may not be comfortable selling options. But guess what? You can sell some credit spreads, okay? But you can't do that if you have a cash account. So I wish more customers would sign up for margin, understand it, and trade it properly. But don't be so afraid of margin. We hear customers all the time saying, "Oh, margin, I can't have that. I don't want to leverage myself and be out of business." But you can use the margin and leverage, to your advantage, very very much so. Let me see. Do I have one more? I wish that customers would educate themselves on, the idea of. We have mentioned this in the past many times on, protection. The zero cost collar is I think an undervalued or underappreciated tool that customers can do. I mean, if you're doing covered calls, okay, and we've seen what's happened, the market's rallied, and as Mark mentioned, people say, well, what can I do? I don't want to sell my stock, so I'll write them covered calls, but I'm still worried. Well, how about buying the protective put? And now you have a zero cost collar on. And I know some of your upside is taken out, but I mean, it protects you in a black swan event. So I wish customers would buy more protection. We see much more. We don't see that much put buying as I think as we should. I think there should be more put buying in general in the marketplace.
Yeah, I agree with you on that one. I think retail should do that. I think more asset managers and financial planners. You'd be amazed how many people still in 2013. Maybe I'll leave it with this. My final wish for 2014 then is that I never again hear someone tell me, why should I buy the put? I can just sell the stock. And that to me is just such an antiquated viewpoint that it's such a binary thing. Either you have the position on, your only real alternatives then are to be longer in cash. And that really is missing out on a whole series of other options, pun intended, there in the marketplace. Yet it's amazing how many sophisticated, quote unquote, asset managers, traders, planners, what have you, still adopt that approach. And certainly there are times when liquidating is the right choice, but that should not be the only tool in your arsenal. And when it is, then that's a very bad thing. You're doing a disservice to yourself and to all of your clients. So maybe I'll leave it with that, my final wish for 2014. And since it only seems appropriate, you guys have been such a big part of the show over the past year, it only seems appropriate to wrap up our final show for 2013 with some feedback from some of you guys out there. It's time for the mail call.
call. Time to look at questions submitted by our listeners.
Another one of our very patriotic transitions. I always feel like it's the 4th of July. Whenever we dive into the mail call, and here as we're wrapping it up for 2013, what better way than to give you guys your final voice here on the program for this year? You guys have been a great part, writing in with such great questions and really providing such great insight for us here on the show, giving us some feedback on what you're looking into and what you're learning, what questions you have. It's been great. And so we'll finish up with two questions here. Actually, one question, and then one's more of a comment. I'll start off with a question here. It just goes by the handle of Ed. So there you go. Very, very creative handle. And he writes, I'm a call writer, but I'm having a hard time finding trades that suit my criteria in this low vol environment. What's your recommendation? How do I find more acceptable covered rights in this environment? Oh, Mr. Ed, a great question, a very common question right now. I was just having the same conversation with someone else recently as well in a very similar scenario to you. They were also covered call writers, and they were also kind of frustrated with their lack of opportunity in this environment. And, you know, I'll have to counsel you kind of the same way I counseled them, in that, you know, most covered call writers, they usually have a certain universe in which they operate. They have their handful of underlyings that they're comfortable with, they know fairly well, and that they regularly write options on. And so when those start to dry up, when the volatility starts to come off, when the risk-reward starts to come off a little bit, you're not left with a whole heck of a lot of options, pun intended again. I mean, you can, of course, migrate out a little bit farther on the liquidity curve in terms of going out expiration months. Maybe you do 2 months out instead of 1, but I don't really recommend that because that kind of doesn't take advantage of all the things we talked about on the show many times of focusing your short liquidity, your short premium trades on that exponential part of the decay curve, which is usually south of 1 month into the weeklies and up to 1 month. But that also being said, you don't really want to go into the deep waters and really force yourself to write something when you don't think the reward is worthwhile. That's probably the main takeaway to take from this. Sometimes it's okay to have an environment where you don't make a trade, because the alternative is to force yourself to do something which you don't maybe really want to do or aren't really comfortable with. Or the other alternative is to perhaps expand your universe a little bit, but that requires a little bit of homework, and it may take you out of your comfort zone again a little bit, which may not be something you want to or are willing to do, because, again, a lot of people have their universe of names they like to write covered calls on. So if you're willing to do that, willing to take that extra step and maybe start investigating a few more underlyings, there are many tools out there that will provide screeners. You can search in terms of implied volatility or changes in implied volatility, and those will give you names that will provide you with more bang for your covered right. But then again, remember, these are going to be more volatile names, so there's probably something else going on in them that is generating those volatilities. It could be corporate action. It could be some sort of biotech name that has a big FDA thing looming. It could be earnings. It could be any number of things. So don't just blindly dive into names because they're high vol. That's very dangerous. You want to make sure you do the same amount of homework you do with your regular covered rights. And at the end of the day, if you're not comfortable with expanding your universe, or you're not comfortable with the levels of premium you're collecting or harvesting for your covered rights, then it's okay to take a week or a month off from a premium harvesting perspective. It's not the end of the world. People sometimes have to realize that not making a trade is also a trade in and of itself. And if you're comfortable doing that, then it's okay to take one off. That said, if it continues, and if we're in a very prolonged vol environment, it probably is time to mix up your strategy toolbox a little bit, and also maybe flip the coin around a little bit. I know a lot of guys don't like to hear this, but maybe it's time to look at buying some options. If things are really cheap, that could give you a lot of great ways to maximize those trades. For example, we talked about using a stock replacement before on the show in the past, and take that stock replacement, take advantage of the low vol levels to put on a stock replacement in lieu of the underlying portion of your covered call, and bam, you've already improved the bang for your buck for your trade by taking advantage of those low volatility environments. And now if you write an option against it, even if you're getting less, you've still improved your overall payout scenario from that type of trade. So there are ways you can take advantage of this. But again, it usually requires you to perhaps broaden your trading horizon beyond just the handful of underlyings and the handful of strategies that you've really kind of boxed yourself into. Mr. Passarelli, what do you have to say here for our friend, Mr. Ed? Hopefully not the horse.
Can I mention one thing about that? I just want to add one thing about what Mark said at the end. If things are so low volatility wise, you can't sell it. Mark hit on it. Maybe you should buy something. Maybe you can do some call spreads and vertical call spreads. So I think that's pretty good advice. I mean, the basic takeaway is don't force the issue. The trade's not there. Don't do it. Step away. Don't force trade. Just like in football or sports, don't force the ball into traffic and make it picked off. So just don't force the issue and maybe change up your strategy. Maybe buy some options, buy some call spreads.
Yeah, and actually, maybe what I should say is, and again, I'm just basically relaying a story to add on to what you said, Mark. What Ed is asking about is just it's a trader dilemma on every level. The last firm that I worked for was a company with arguably some of the best option traders in the world, professional traders. Incredible. I mean, these guys printed money every day. And it was, I want to say 2008, maybe early in the year when volatility was low. I mean, I kind of forget now. It's over 5 years ago. And they'd have company meetings all the time where, all 100 traders would gather around in this gigantic room, and like the head of the organization would give some words of wisdom about trading. And he basically said this exact same thing. He said, well, it's a low volatility environment right now. I don't want you guys out there selling cheap insurance that has the potential to blow up on you, but it's kind of tough to buy options also because when you buy options, you need the stock to move, and volatility is low because the stocks aren't moving. So, it's kind of really a business cycle thing. Sometimes trading is better than it is at other times, and trading is good for option traders when there's volatility in the market, and it's not as good when volatility is low. But, that doesn't mean that there's not trades out there. It's just that they're harder to find.
Indeed. Do your homework, expand your toolkit, expand your arsenal. It's amazing how I get almost like the back crucifix away vampire look whenever I mention to these option writers that they might want to buy something. It's like I'm just taking them from the dark side to the light side, and they want no part of it. It's kind of funny. All right, and then we're going to wrap it up here with another, I guess, like a comment coming in from Tom Giles, writing to us out of lovely, scenic Newport, Rhode Island. Haven't been there in a few years, but lovely place to tour. Check out all the old summer mansions of the Victorian era. I'm assuming they're similar to the Passerelli summer home in many respects.
Similar. It's like is that canvas or is it?
Yes, the Passerelli summer tent, I should say. All right, and we're going to wrap it up for the year here with this comment from Mr. Tom out of Newport, and he writes, I just want to thank you guys for putting together this program. It's really been helpful for me as I take my first fumbling steps into the options market. I've been mainlining the show on my commute every day. I like that. And repeating episodes that are particularly suited to my trading style. I've already identified a few mistakes in my trading and also adopted a few of your suggestions, including stock replacements and short puts for limit orders. Thanks for the help. When can I look forward to a daily show? I have a long commute. All right. Well, Tom, we're glad we can help you, and that you guys like you are really the reason this show exists. We want to put something out there that is interesting and compelling and actionable and can provide you with some very straightforward and meaningful and useful tips and strategies that you can turn around and employ in your own trading account. And from the beginning, this show has never been about crazy iron condor ratio strategy or straddle swaps or any of that crazy stuff you may hear bandied about in other shows. I mean, options, as we said many times on the show, they are more approachable than you think. They are more useful than you think. When they're used properly, they are risk mitigating, not risk additive. And we hope we've taught you some of those strategies here over the past couple of years on this show. And we're very, very happy to have done that. And unfortunately, I don't think we have any plans for a daily show. That'd be kind of fun. That'd be a lot of educational topics to get to. Maybe we'll think about that for 2014, Tom. But we're glad you could listen to the show. And we're really glad all of you guys out there, I think all of us here on the panel are really thankful for all of you guys out there in the listening audience for making this show such a success year after year, for continuing to drive it up the iTunes and Stitcher and other charts, and really consuming it on your commute and when you're working out and wherever a lot of you guys like to listen to the show. We're really glad you guys like it. Your response has been great, which is why we'll continue doing it, because we like doing it so much and because you guys have responded so favorably. So thank you, Tom. Thank you, Ed. And thanks to everyone out there, really, for listening and for making this show such a fun show to do and such a success. And we're looking forward to many more exciting shows in 2013. And I know Dan and John, you guys both want to leave our listeners with something as well. So maybe, Dan, we'll start with you first. What would you like to leave our listeners with as we close out here in 2013 and look forward to 2014?
Guys, speaking not just for myself, but I'm pretty sure I can speak for Mark and John on this as well. The three of us, our whole lives have come from what the fruit that was bared in the options market. The down payment on my house is from trading options. My whole life has been trading options for the last 20 years, being involved in this industry. It can be a really, really great industry. It can be a really, really great thing for you, both financially, mentally. It's been a great experience for me, and I think it can be for you. You get out of it what you put into it. When you have those times when you're frustrated about trading, hang in there. You can make it through those times. And the times that are great, ride those out as well. 2014, maybe it's going to be your year as a trader.
All right, Mr. John, take us home, sir. What do you want to leave our listeners with as we roll on into 2014?
I think I want to thank Mark and Dan, for putting on the show and for our listeners. I think it's an incredible tool for our Sogo Trade customers and introducing ourselves to the other customers out there. And I think that it's just so valuable to have a resource like this. And I just want to echo what Dan said. Even as a trader, you have your ups, you have your downs, and you just try to keep everything on a smooth, even keel and do the smart thing. Never be greedy. Take your losses, ride your winners, and looking forward to 2014 and a great year. And thanks again for everybody for listening, and we'll see you next year.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.